Are we destined for global recession one way or another? Is it now inescapable? This is the question that markets are going to be asking themselves this week after what happened in the first few weeks of June here. This is Ilya Spivak, head of global macro here at tastylive, and this is, of course, Macro Money. Welcome to the show. We're going to be looking at all kinds of important event risk this week. Of course, last week started us off. It's been an action-packed month, in fact, for all kinds of things in this macro landscape. And so what we're going to do here is we're going to take a look at the breadth of what's coming this week and whether it will move forward this idea that a global recession is now inescapable and what that might mean for global assets, and if we might actually duck it and there might be a more soft landing kind of a scenario and what that could mean. There is a busy economic calendar here once again. We get a bit of a reprieve here on Monday, but after this, things heat up. So let's set the stage and figure out exactly what the moving parts are first and foremost and fit incoming event risk into those frameworks to see what it might actually do. So we begin with what is the European version of Jackson Hole. We know, of course, that the Federal Reserve gathers all of the world's central bankers and macro thinkers in Jackson Hole, Wyoming, once a year for a big sit down to discuss where the world economy is going and what they're going to do about it. We have the ECB's version this week. Everybody's gathering for the ECB Central Bank Forum in Sintra, Portugal. That's right outside of Lisbon. And they're going to have these big conversations. Fed Chair Jerome Powell is going to be there. We are going to have, of course, ECB President Christine Lagarde hosting. We're going to have the IMF make some presentations, the World Bank make some presentations. BOJ Governor Ueda is going to be there. BOE Governor Andrew Bailey is going to be there. And this is really where we should hear what these central bankers are thinking about in the context of what's going on. And what that is appears to be a global slowdown that, while it is happening as scheduled, is struggling to contain inflation. Take a look at what we're seeing here. This is the path of global trade volumes in the dark line there. Tellingly, it tops right as the Fed really starts its rate hike cycle. And we're using the Fed here as a sort of benchmark baseline. Of course, it is, as I've argued before, the most important of the central banks because it is the steward of the US dollar. And so because it controls borrowing costs or influences decisively borrowing costs on the greenback, which is overwhelmingly the commercial unit of exchange of choice, Bank of International Settlements puts the share of global transactions settled in USD as close to 88%. That influences borrowing costs everywhere. That is not to say, of course, that other central banks haven't joined in the rate hikes. They, of course, have. It's just the Fed has really been out front and has been most influential on this. So you can see here, as Fed rates shift higher and expectations for further tightening remain, this is basically a 1 month forward look at where Fed policy rates are expected to be at any given time. You can see you have that spirited rise there, and that, not surprisingly, is cooling economic activity and in particular cooling trade because, of course, all of that trade typically is financed in dollars. And not surprisingly, that has created something of a greater hurdle on investment and on business activity, and that business activity has started to wither. You can see that with about a 7-month lag, it is in fact having a disinflationary effect. So world CPI is off the peak. It is lagging what's happening with economic activity by about 7 months, but that's not unexpected. The lag's vary from economy to economy, but on a global scale, not surprising that it takes time for a new set of financing conditions to influence actual CPI, because of course contracts don't get renegotiated nightly. So it does take time to kind of work its way through the economy. And so there's been some success here. However, there is also a bit of a worrying bit in this. And that is, of course, that inflation expectations have stopped moving in the right direction. You can see they topped out at the same time as CPI. If we lag that CPI to expectations, you can see that the bottoms and the tops generally line up. But it is worrying and should be worrying for central bankers that inflation expectations here, as tracked by an average of 10-year break-even rates in the developed market economies, that they've stopped declining. What that means is that central bankers have not done enough, supposedly from looking at market perception, to keep inflation expectations continuing to go down. And so while we are at this point looking at CPI that's give or take about 6% for the world at large, the target for most global central bankers is somewhere in the 1 to 3 range. So we're still well off target. There's a long way to go, and the inflation expectation being priced into the bond market here across the US, the UK, Australia, Eurozone, and Japan, which is the average that red line captures, you can see we are not really continuing to move forward. That, of course, is something central banks are rightly concerned about, because they don't want inflation expectations to get baked in at these levels, because that will influence behavior and keep prices sticky. If you're expecting that prices are going to be 6% higher year on year in 12 months, well, that's going to cause you to do something quite different than if you think it's going to be 2%. So, needless to say, central bankers are concerned. Now, as this is occurring, global economic data is showing meaningful weakness. Take a look at how the major economies are doing here, and you can see economic data out of the G10 space has increasingly underperformed relative to expectations. And last week's abysmal run of PMI numbers really is a case in point. That's that sharp, most recent decline that you're seeing on this index. At this point, you can see it's sub the zero line, which means economic data from the major economies is tending to underperform relative to baseline forecasts, and by a growingly severe margin. So all of this seems to suggest that, in fact, the clampdown that central bankers have already instituted is having an impact, even as inflation expectations are idling, which suggests that there might need to be the kind of squeeze that actually pushes growth into recessionary territory to get those expectations moving. And that, of course, is exactly what central bankers are going to wrestle with at this Sintra forum. Of course, the main issue here seems to be that on the service side of things, which tends to be the dominant sector in most major economies, you have not had the kind of weakness that you've had in manufacturing. Manufacturing reflecting what we've just seen on global trade, this right here. Not surprisingly, that's hitting manufacturing first, because that is the goods trade side of things. That speaks directly to this decline in trade volumes. But services, you can see, still significantly upheld, probably to a significant extent by lingering effects of stimulus. And of course, by what's happening in labor markets. A lot of what's going on in labor markets around the world and shortages of labor in primarily the service sector, which tends to be the biggest employer in most economies, that's creating inflation that's stickier. There's also creating a level of uplift in services more generally that is holding up the larger composite numbers. We can see that in June, perhaps they're starting to roll over a bit, but the gap in between services and manufacturing is still huge, which would suggest that central bankers have a long way to go to get these inflation expectations to start moving lower again. The data needs to start showing a service sector that's meaningfully slowing in order to suggest that the labor market conditions there might provide some disinflation finally. And what we then have to ask ourselves is, in an environment where this is already how dire things look, what would it take and how much pain would be required? And is a global recession then inescapable? Because this is what central banks are going to do in order to contain the issue. So the message that we're going to hear from Sintra is going to be very, very important and should be stage setting for at least this week, but probably longer than that. It'll be really important to hear from most of these central bankers where the priorities are. And if the message that we've heard from the Fed, the Bank of England, the Reserve Bank of Australia, the breadth of the major central banks that have announced so far this month, with perhaps the exception of the Bank of Japan as ever, we are looking at a primacy of price stability over near-term growth in the minds of most of these central bankers. And so what we're really looking at is perhaps language that suggests central bankers are prepared to countenance a meaningful economic downturn if that's what it takes to get inflation expectations hemmed in. This is, of course, what they can do. This doesn't speak to anything that the fiscal authorities might do, either on efficiency or on government spending. And, of course, the counter to that, fiscal tightening, which might help central bankers here. But nevertheless, lots and lots and lots on this subject due over the next several days from exactly the people you'd want to hear it from, the horse's mouth, as it were. Next on the calendar, Canadian CPI data. This is actually more important than perhaps meets the eye. Here is the view on Canada's inflation as relative to expectations, and you can see this in spades captures what is going on globally. Disinflation continues, the latest number 4.4, down from 8.1 at the peak, but expectations have stopped declining. There's the 5-year break-even, idling. It's idling right near target, which is helpful, but it has stopped moving lower. What that means is that markets are basically priced for perfection. Absolutely nothing can go wrong. And as we learned here just over this weekend with the maybe coup, maybe not coup in Russia, spontaneous things happen to change the landscape all the time. So all of these central banks would ostensibly prefer to overshoot and be cutting into a slide toward their target, rather than hope that the amount of tightening they've done is enough, and they're not going to have some sort of a sudden inflationary shock that puts them back behind the ball. We've seen that movie already. Going into the back half of 2021, it looked like central banks had a good handle on things. It looked like the tightening cycle was starting to be impactful, that it was going to do its job, and that we wouldn't have to go too aggressively. But then, of course, we got the war, and that created all kinds of knock-on effect on energy, on grains, and now remains a risk, albeit somewhat in the background, but only just so. The moment something happens that's impactful, it will vault from the background to the foreground once again. So we're in a situation here where central banks almost certainly want a bit of buffer. They don't want to be surprised with higher inflation because, say, there is another coup or, in fact, some sort of a unraveling of the Russian state that then, let's say, compromises the Black Sea oil initiative, shipping grains out of the region to parts of the world that desperately depend on that supply to feed themselves. The kind of instability that could happen if that were to be disrupted is not something that can be really minimized. It could be absolutely huge. So it is then really important to look at how this CPI data out of Canada might come out, because the last time that the Bank of Canada announced, they surprised with a rate hike precisely around these very conditions. They would like expectations to go down. As we can see here, we have here the forecast calling for significant disinflation at the headline from 4.4 to 3.4%. If that number surprises higher and we get some sort of consternation in markets around that, expecting a still more hawkish BOC, well, then we might get sympathetic response across other markets, much as we did when U.S. yields rose as the Bank of Canada hiked. You might think it would be localized to Canada, that those yields would go up, that the Canadian dollar would go up. But no, the market very clearly and astutely looked at the situation and said, this is a window into the U.S. If things look too hot in Canada and the central bank is acting, and Canada exports close to 70% of everything it sells to the U.S. and so is tied at the hip to U.S. demand, this is not just a Canadian story. Now, looking at how expectations have evolved since the last BOC meeting, we can see there's the hike there from 4.5 to 4.75. But what you don't see then is a significant change in yield curves, be it since the meeting at the beginning of the month or a week ago. So we're basically in stasis mode here. And it'll be interesting to see if we get dislodged out of it, and whether we're dislodged in a more dovish, more accommodative direction or a more hawkish one. If it seems like we're going to get a move in these rates structures that's a little bit less hawkish, if the yield curve shifts down a bit relative to where it was in the beginning of June, because CPI does in fact come in soft, that might be read as extrapolating a more accommodative stance from the Fed, and so from other major central banks and just global liquidity conditions in general. And of course, if it surprises higher, the alternative. Next, China. We, of course, know that the situation in China has been fraught with disappointment. There was a lot of optimism linked to this idea that we're going to get the reopening of the world's second largest economy in December of last year. That's going to be a huge tailwind for everything. And of course, not so much. We had this surge in activity at the reopening. You can see it with clarity here in these PMI numbers. And just to clarify, this is the official set. There's also the Caixin set of numbers that will come out next week. That's the private sector estimate. But from the official PMI numbers out of China, there's that initial bump. As 2023 gets underway, it has since receded. Manufacturing is back in contraction territory and is expected to remain there for the latest set of numbers. You can see that is expected to come in at 49. That's a little bit higher from the 48 and change in the prior month, but still in the logic of PMIs under the 50 boom bust level. So manufacturing will continue to contract here as expectations have it. Services are also seen slowing significantly. And that speaks to the benefit from the reopening, the premium to letting essentially a giant population out of lockdown. That seems to be waning here, as is any kind of inventory and orders overhang from the lockdown that is being caught up with now that things are reopened. So we have a situation then where the world's second largest economy is somewhat teetering. And of course, this is a huge, huge story for a global recession scenario, because the world's second largest economy is an incredible and large part of that whole. It increasingly looks like a weak link. Here's essentially what's going on. You can see here that the peak in US and Eurozone composite PMIs occurs nearly 2 years before the peak in China. There's the reopening in December of 2022 there. You can see both official CFLP and Caixin private sector Chinese PMI numbers go up at that stage. But by then, most of the world's major economies, certainly the US and the Eurozone, the major nodes of demand for China, at that point, they're already on the decline. Growth is already slowing. The premium from COVID reopening is fading. And of course, they are already by that point 9 months into a vigorous rate hike cycle. So China is just not seeing the end demand from these areas that it might have hoped for to power this reopening and really give us a pre-COVID kind of China. That's just not what we're seeing. You can get that in spades looking at this economic surprise index for China, where you can see there's the surge about mid-January in the data as the reopening really starts to take hold. It crests in April, and at this point, economic data is doing relatively poorly. We are at this point at a setting for economic data that's much more akin to where we were during the lockdowns. So this is, needless to say, a huge input into whether we are in fact going into a global recession, because if there was going to be some level of offset, it would be China, where there isn't a meaningful amount of tightening, where in fact there is a push to stimulate. But if the numbers are going to suggest that in fact this hasn't been working, at least up to this point, that should be sobering for everybody concerned about what other central banks might do, or what other policymakers might do, as we've just talked about, to get inflation expectations moving lower again, and what that might mean sum total for recession risk and for risk appetite across markets. And then, of course, there's the U.S. PCE report to round us out at the end of the week. The June number expected to give us the PCE reading sliding to 3.8%. That'll be down from 4.4. We can see that would also rhyme with the already released CPI report, which fell from 4.9 to 4% over the same period. And of course, the question here, much the same as the global one. Inflation expectations aren't really going down. You can see the 1-year inflation swap at 2.4, the 2-year break even at 2. So what the market is basically saying is that we are going to somehow get from around 4% inflation to about 2% inflation in 2 years. And that the bulk of that disinflation will happen within 12 months. So down from about 4 to 2.4. Now, take these numbers with a grain of salt. The inflation swap and the break-even don't have to necessarily line up exactly in terms of what those numbers mean. So the 2.4 and the inflation swap isn't necessarily equivalent to the starting point for a decline to 2. There might be some tens of a percentage point difference here or there. These are different instruments, different liquidity parameters, et cetera. But the larger story remains. How do you get from 4 to 2? Well, if you consider that most of the supply chain efficiency that was there to be squeezed has been squeezed at this stage, and in fact, the latest PPI numbers show it very clearly, intermediate good distributive costs, so the costs to move intermediate goods around the U.S. supply chain, are actually shrinking at this point, year on year. For final goods, it's still up, but the growth is so meager as to be below the pre-COVID setting average. So it's not going to be efficiency, most likely, in the delivery of goods. It's likely going to have to come from economic pain, from slowing the economy and deflating the labor market exuberance, primarily still held up by the service sector. So very much a window into the world and the broader conditions of things. Now, in so much as this was already anticipated by the CPI report, it may not have immediate market moving potential by itself, but it will come on Friday after all of these other things, after the ECB forum, after the news out of Canada, the news out of China. And so contextually, this might be really significant. We can see that the U.S. yield curve has meaningfully shifted to a more hawkish setting, even as the Fed paused rate hikes this month. So you can see the last rate hike was early May. The current yield curve is at a more hawkish setting than that. In fact, over the past week, we haven't really had any movement on it. So even as we've had this somewhat disappointing economic data, rate hike appetite hasn't seemed to fade out of this. And so we look at it and say, okay, well, yeah, the Fed paused in June, but not only have monetary policy expectations not moved to a more dovish setting as a consequence, they're actually more hawkish than they've been since the last time the Fed did hike. And so it seems like the markets are starting to perceive this sense that central banks really are ready to sacrifice growth on the altar of disinflation. So with that in mind, the PCE numbers might be very important in context. If they are relatively up as compared to expectations, and we get a very meaningful hawkish message from central bankers over the course of the week, and maybe the Canadian numbers also register a bit warmer, maybe the Chinese numbers register a bit softer given how they've been performing relative to expectations, the upshot is going to be higher rates, weaker growth. And that, of course, should be relatively bad news for risk sentiment. And to the extent that the PCE number endorses any of that, it could, in fact, have market-moving capability, even though by itself it may not reveal anything terribly novel. You can start to see the makings of what could occur here already. You'll notice we've seen a kind of Goldilocks situation since the banking crisis broke out and settled in March. At this point, we might be going, perhaps preliminarily, the other way. So S&P 500 futures here, a measure of overall risk sentiment, it has been going up as the OFR Financial Stress Index, a sign of credit turmoil, has been going down and is now actually still, or was certainly last week, at levels lower than before the SVB-led debacle occurred. Notice, though, we might be rounding something of a top on stocks and a bottom on this financial stress index. As financial stress has picked up, so too stocks have wobbled. Now, it's a little bit early, but if in fact the message from central bankers and the data this week is we're going to fight this inflation, it appears to be stickier, and growth is already suffering tremendously, then the answer going forward will be we're going to have weaker growth and higher yields. That isn't good news for stocks. It's almost certainly not good news for cyclical commodities like a copper, which we can see has been falling in sympathy with stocks around this narrative recently. It is probably a positive environment for the dollar and for bonds. It is probably a negative environment for almost everything else. Stocks, we said. Cyclical commodities, we said. We can likewise put into that stew emerging market assets, likely crypto, likely precious metals. Though gold might do a little bit better than, say, silver or palladium, the latter two more impacted by risk-off concerns on the downside because they're a little bit more industrial. Gold a little bit more uplifted even as the dollar rallies in some kind of a sell-off here because it does tend to benefit from weaker yields. So if bonds and the dollar both go up, gold might be a little bit better supported because that would be lower yields and a stronger dollar. That conflict is typically something that helps to keep gold from being too volatile, as opposed to when yields and the dollar move in the same direction and give gold a lot of directionality up or down. And that is the week as it shapes up ahead. We're going to take each one of these pieces and delve into them deeply as the week goes on. So come back to Macro Money and listen for that. We'll hit the ECB forum tomorrow. Then we'll transition into talking about some of these other things as the week progresses. We'll, of course, check in with China. We'll check in with PCE going into the end of the week. So do tune in. This is happening every day here, Macro Money, Monday through Thursday, right after overtime, a show where Chris Vecchio, head of Futures and Forex, and I look at that day's events and what they might mean going forward across markets. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the news and insights section on tastylive.com, and then opining on Twitter at Ilya Spivak. Thank you very much for joining, everybody. See you tomorrow.